Good morning and welcome to the ROCKWOOD Strategic PLC Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. I would now like to hand you over to Fund Manager Richard Staveley. Good morning.
Good morning and hello everybody. Really pleased to be presenting this morning on ROCKWOOD Strategic. The plan is to be relatively quick run through how ROCKWOOD Strategic goes about its investment process and how we think about investing in UK small caps. We've got a mix of people probably listening in today. And then we can talk about some case studies, which I think is the best way to illustrate how we go about things, and then get on to Q&A. I'm going to try and keep it a bit shorter than normal. It's Christmas time. Want to keep it efficient for all the listeners. So without much further ado, there's the disclaimer. I believe the presentations are uploaded off later, so you can read that at your leisure. So ROCKWOOD Strategic, what are we trying to do? We're trying to maximize and compound wealth long-term for shareholders. We are targeting the inefficient microcap UK market, stocks under 250 million, but the vast majority under 150 million, with significant specialist expertise. We work out of Harwood Capital, which has a range of teams within it, including private equity, private debt, private property, and other mandates in the UK's equity space. And we benefit from a long and well-established network in terms of our approach. And we're targeting investments that can deliver for our shareholders 15% IRRs over the long term. It's quite important because most small cap managers are benchmarked against the index and focused on relative performance, relevant in a year such as this for obvious reasons. And finally, we are 100% focused. This is the only fund that I'm focused on, and we are highly aligned as a fund manager. Harwood and myself have purchased 29.9% of the shares in ROCKWOOD Strategic as long-term shareholders and want to enjoy the fruits of compounding long-term as much as everybody else. So what's the investment opportunity? Well, there's a huge structural inefficiency, we think, in small cap UK equities. Money has concentrated into much larger groups who find it very difficult to invest in much smaller companies these days. We are aware that post MiFID II and a range of other structural changes to the broking community, the coverage of very small companies has dropped off a cliff. And as a result, we think that on a structural basis, stocks are regularly materially mispriced by the stock market. It's a significant universe. Under 250 million market cap, there's about 1,200 companies for us to find a few nuggets from. And many of these are under-researched, what I call, hidden gems. They might be fallen angels, so businesses that used to be much more loved or in better shape that have fallen from grace. Lost corporates, meaning companies that have sort of lost their way, their dynamism's reduced or their strategies started to either fail or become stagnant. And also a number of interesting sort of family owned or predominantly owned businesses where generational change is underway. We have a value and recovery mindset, which we think is differentiated from most other UK small cap institutions who are either balanced or much more focused on finding growth winners. We look for turnarounds mainly. And we think that through our focus portfolio, we, by undertaking material due diligence, we can create an information advantage over the rest of the market by the efforts that we put in to understand the business and our interaction with them. We have an engaged approach. It's not activist, but it is a constructively engaged approach whereby we spend a lot more time with our companies than your average fund manager. And we believe that this enhances the investment outcomes that Rockwood can deliver. I reiterate that it's a long-term capital vehicle. We benefit from this illiquidity discount that a lot of these stocks do by embracing that illiquidity at that lower level of valuation, and then in the end driving an outcome for shareholders where that discount has narrowed in. There's a couple of stocks there on the right, past wins, but again, companies like Universe were materially where bids were coming in at 100% premium to the share price, suggesting how inefficient this market can be. This would be the typical life cycle or under which we invest. So we're looking for proven businesses with identifiable assets. We're not looking for loss-making, unproven emergent companies. We have a value investor mindset, which means we're very free cash flow focused. We identify the catalysts that are required to turn around and sort out a company, the catalysts for change. And then we engage with all the stakeholders, board, executives, teams, customers, suppliers, and other shareholders with regards to how change may occur. We establish the mean reversion potential, meaning how profitability can recover back to what it was before, and what's required to turn the business around, or what's required to repair the balance sheet and get a re-rating of the earnings streams that the company should be delivering. And at the outset, we develop an exit thesis. We can't be sure of that outcome being, but we spend a lot of time at the start considering who would be the likely buyers of the stocks that we take these large stakes in. Is private equity active in their sector or their niche? Are trade buyers consolidating, or would a particular one or two trade buyers really benefit from this business if it was stabilized? And that helps us de-risk the likelihood of being stuck in the company very long term. Again, I'll do this as quickly as I can, but the target life cycle would be businesses that they've made strategic error, bad M&A, management's got complacent, tired, or it's just actually not very good, and typically leading to ineffective operational execution and depressed profitability, depressed margins. RPS, another past winner that was in exactly that case after the CEO had been in place for over 20 years and has been bid for this year. This sort of deterioration in the business leads to a depressed valuation as shareholders give up and no one feels there's a sort of positive future there. Often leads to financial stress, which leans on the valuation, and is almost always a high emotional backdrop for the stakeholders, both the management in terms of their decision making at that stage, but also shareholders who tend to be rightly upset. And the dominant narrative by commentators is typically negative. Nothing's ever going to change. It's not worth bothering about. This would be the case with MC Saatchi in recent years, where the founding team, again, maybe have been a bit too long. They put the business model under stress through poor financial controls and also a flawed M&A structure. And as a result, shares really hated when we were establishing our position about 18 months ago. And that's now it's now got new management. It's starting to improve its profitability. Crestchic, I will talk about shortly. I kind of think you can see me, but I've got a large smile on my face. We literally just had a takeover approach for Crestchic last week. This phase where the arrow is going up is where the company undertakes a value creation or realization strategy, where there's typically changes to management and the board, where a kind of operational plan is put in place to turn around the business, where we can target a fair and reasonable level of profitability, returns or sales recovery too, and the balance sheet stabilizes. And hopefully at the end of that process, you get an outcome like an Augean, where we made many multiples of our money in, where the ratings normalized, returns have improved, the narrative has completely changed, and we deliver our IRRs. You note there that the realized IRR of Augean was exceptionally high at 99.99%. I repeat that we target 15%, although I'm sure all of you will understand we actually target higher and know that we won't get everything right, so we need to expect that too. The process, very simple. We have quant screens and an extensive network. We often get people coming to us saying, can you help with this? Could you take part of our stake and help sort this out? Or advisors and indeed companies themselves. We then do due diligence, and we may buy a modest position at that stage, a 2 to 4% weighting type position. And then we will after that expand our due diligence, which includes the feedback and insights from our investment advisory group. We then develop a plan, engage with stakeholders, purchase the stock, and then monitor very actively going forward through to hopefully a exit liquidity event. So this slide's almost not necessary actually, other than the most important point would be that we are concentrated, we are focused, your typical small cap fund, many more holdings, which is why in a year like this, most of the small cap funds are down roughly the same or not that dissimilar from a very difficult market for small cap investing, because if one has 50, 60, 70 and more stocks, it's very difficult to have a very uncorrelated outcome to the market. The flip of that is that we are very dependent on the stock specific outcomes within the fund, but we clearly benefit from all the good things about why small caps generally tend to generate the best returns in the market. I'd just only add that we are allowed to invest up to 15% in private companies or instruments. We're flexible. It can be a kind of debt instrument like a convertible, which we had in Crestchic, to help the refinancing of the business. Or the only position we have that is a private instrument or company at the moment is a small shareholder facility loan that we're making to Bonhill, a company in the portfolio that is currently in a formal sales process. We might talk about that later. So case study, Crestchic, now a £112 million market cap business. The takeover offer came in on Friday. They've got a significant amount of irrevocables, including ourselves. So if that went through at the bid price of 401p, we will be making over 6 times our money and well in excess. And I think we're as pleased with that outcome as we are about the whole process of Crestchic. And there you can see a quote there from Peter Harris, the executive chair of Crestchic, about our involvement with that business during the last few years. And we're really pleased that he is clearly stating what we do. It hasn't been unpleasant having us. We've been helpful, made sure that all shareholders at Crestchic and stakeholders have benefited from our involvement. So in a bit more detail, so what was Crestchic? Well, it's the largest manufacturer and renter of load banks outside America, which test power reliability. So think hospitals, backup power in hospitals. It's an interesting day to be talking about hospitals, but when the power goes down, the backup power needs to absolutely work. for surgery and all the other reasons why that's obvious. And so as a result, needs to be tested and use a load bank to test that. And data centers also very strong growth area for them that also use load banks and the services of Crestchic. We entered the stock, the strategy entered the stock back in 2016 at 75p. And that involved both an equity involvement and slightly later a convertible involvement as well. And for the first 3 years, the stock increased a bit, got up to about £1.10. And in late 2019, we started engaging heavily with the business to make sure we could deliver the returns that it should be delivering. We introduced a new non-executive director, not as our representative, but someone who we know would be good to give a fresh set of eyes to the board, called Stephen Yap. The board took that, brought him on board. Not long after that, after a thorough review, the CEO retired, and Peter actually moved from a chair role into an executive chair role, which occurred in early 2021. We got a COO appointed to support on the operations, which needed improvement. And in early this year, Nick Mills, who's on the investment team at ROCKWOOD Strategic, also was appointed to the board as a non-executive director. We engaged with Crestchic on improving its ROCE focus. If you look back in the accounts, it was oral presentations by the company, which was actually called Northbridge Industrial Services or Solutions prior to its name change, which was part of this turnaround. And we felt that there was insufficient ROCE focus and transparency, and that was adopted by the company in reporting. And there's nothing like adopting a measure to get people to focus on it. And the ROCE that Crestchic will deliver this year will be absolutely outstanding, best in class for any UK company, actually. We obviously engaged on board evolution, mentioned the changes there. We engaged heavily on an LTIP and incentivization plan to ensure that management and the team were really focused on shareholder value, which we created in 2021, or was launched in 2021. Most importantly for me, they had a second business called Tasman, which rented equipment to the oil and gas industry and had been loss-making for a number of years, was bought near the top of the last oil cycle. And we felt that this really had to go. We engaged on that view. And eventually, as part of a strategic rethink, the Tasman business was sold and sold earlier this year, allowing the management to focus entirely on the Crestchic business, rename the company Crestchic, and also allow investment within the business to focus on expanding the Crestchic plant, which is a picture of it that I took actually earlier this year when it was officially opened, which added a lot to capacity at Crestchic. We were supporting investment there heavily at ROCKWOOD, and allowed them to accelerate the delivery on their fantastic order book they've got at the moment. Finally, we also did spend time with them on their IR emphasis, and felt that they could do, which they have successfully done, explain how energy transition as a thematic is very, very positive for the business. Few key facts here. The Harwood Group, not just Harwood, but also other Harwood funds, and have 25.1%, so a huge stake in the business, allowing us that influence. And apologies. And the weighting in the portfolio was 31% as of last week. It's run quite strongly into this takeover approach. Fantastically, we will have significant cash at the start of next year to deploy into a very interesting market for small caps. The takeover approach was from a Greco at about 10 times EBITDA. The business has historically been valued on much, much lower multiples. EBITDA itself has gone, skyrocketed during the last 2 to 3 years. Northbridge was actually loss-making only three years ago overall. And we're just really, really delighted with this as a case study. If we can keep doing this in the portfolio over the next 15 to 20 years, everyone will be very, very happy, I hope. This is the rest of the portfolio core holdings. These are ones where we have stakes and influence. You can just see the EV/EBITDA multiples, Crestchic there at the higher end now, at the end of that investment life. I'll just add here, you can see the ROCKWOOD stakes in the third column running down from 14% in Crestchic. I mentioned Harwood itself had 25.1. I just add here that Harwood, other funds and affiliates, we're actually at over 28% in Flowtech Fluid Power. And one of the members of the investment advisory group, Jamie Brooke, joined the board of Flowtech Fluid Power earlier this year. And Centaur Media, where ROCKWOOD has a 6% stake, Harwood group companies have in total have 29.9% of the company, and I'm a non-executive director on that business. You can see those, but basically right at the bottom end of small cap, well under 150 million, and reasonable balance sheet positions. So what happens next following Crestchic? Well, first of all, we've got other stocks in the portfolio with decent sized positions, which we're very excited about. Centaur Media is one of them. It's a deeply undervalued business, given the quality of what that business is now, which has been transformed over the last few years by the new management team there. It's a high quality B2B media business. And it's set out a plan a number of years ago to achieve a pretty, I would say, stretch target of 23% EBITDA margins, which would be fantastically profitable media business, best in class. And gradually over the years, they've been increasing in that direction. Part of that has been to do with very clever cost cutting and restructuring by the team, but also they have shrunk down the business from what was 8 divisions down to just 2 left, one in law and one in marketing services. The law division, very simple. It's based around the fantastic brand, The Lawyer, which if any of you know lawyers or you'll ask your lawyers, they're bound to take a subscription to. It's a great property, well edited, lots of information for lawyers about their industry, about what's going on, and a bit of a must read. And they have award ceremonies around that and other spin-offs and a bit of training. And it's a very profitable and strong brand. Their other division has a number of businesses within it, all focused on the marketing industry. Think CMOs or chief marketing officers in large businesses, and also mid-sized and smaller businesses that are growing. You can see the brand names there. E-Consultancy is the largest of those, and essentially consultancy is almost it's definitely part of what they do, but a lot of it is actually training related and training up people within businesses such as large blue chips such as Unilever, where they help the Unilever marketing departments on their digitalization and their marketing approach. Influencer Intelligence is an influencer business where they have over 500,000 people on their books, which they advise the clients on who they should use for various campaigns. And they have a fantastic e-learning and training brand called Mini MBA, which is an accredited MBA, costs about £1,700, which is almost entirely online and has been under a lot of growth in the last few years, not just in the UK. And companies are paying for their employees to do the MBA, and individuals are also choosing to do it to improve their career prospects. Anyway, to keep it simple, the market cap's about 57, 56 million, and it has a very significant cash balance, 14 million pounds of cash. Harwood actually believe they don't need all of that cash and are engaged on that matter. But it has a very strong cash position, which means the enterprise value is just over 40 million currently, and market expectations are to do 8 million of profit this year. That's on just over 40 million of sales. So in terms of that journey, they are now, tracking close to 20%, which is a fantastically profitable media business. Clearly not worth sub 6 times EV/EBITDA, and we expect the market to increasingly realise the trajectory of the business and the quality that it's been on going forward. Next case study. Again, I would love to get to Q&A as quickly as possible, so I'll do this slightly quicker. But a big holding we've bought this year is in a company called RM. It's a educational supplies business with over 225 million of sales. For that, you only pay a 35 million market cap now. Shares have absolutely collapsed during this year, primarily because the company has had a sort of botched rollout of an ERP system, which has gone massively over budget, which they'd intended to go into debt to fund, but the debt has gone up far greater than, or the cost of the rollout's been much greater than they expected. And as a result, there's financial stress has gone into the business, just like I was explaining what we looked for earlier in the presentation. So the shares have collapsed. The reality is that the underlying businesses are all in good shape. It has 3 divisions. One's that sells resources to 90% of all primary schools in the UK and a ton of the secondary schools in the UK. That has a long history of making good cash profits. Has a second division called assessment, which is basically exam marking, where it has contracts to mark things like the ICAEW accounting exams, A-levels, the International Baccalaureate. That's been growing very nicely over the last few years, both in the UK and internationally, and is a high margin business. And then they have a third business called technology, which provides IT services to schools, which are gradually consolidating into groups of larger numbers of schools, so more interesting type of contracts, which RM likes to win in order to serve those companies, both with everything from help desks to trainings to cloud services to the actual computers. So the business, we think, has at least some of the parts of 150 million pounds, including all the debt and all the rest of it. We think when it's stabilized the project, which is not yet done, so we're in a risk phase right now, a bit like Northbridge was many years ago. In this risk phase, we need to stabilize both the balance sheet, the project, and then we can get back to RM generating the types of returns it should be. We think they have potential to do 20 million of earnings. And as a result, you can see, we personally think that there's at least 400% upside in a fully successful investment thesis for us. The Springboards and opportunities stocks, I think I should only probably mention one so I can get on, because there's been lots of questions coming in. So I'll just pick one, just to explain exactly what Springboards and opportunities are. I touched on that they're a smaller position. They're one of 2 things. So they're firstly businesses that we'd like to take a much bigger stake in, and a much bigger position in, but we feel that we need to be on the shareholder register in order to get the right level of access, or be taken seriously enough by the company so that we can complete our due diligence. Or we've already sort of done that, but there isn't the liquidity to be able to take that big position yet. So we take a position anyway, and we're looking for the opportunity to scale that up at some point in the future. The other type of situation is just a straight opportunity. There's typically a handful of those in the portfolio at any one time, which are businesses where we don't need to get as engaged as the others. As you can probably imagine, this is a very high intensity, high energy type of investment approach. So we do sometimes see opportunities where change is already underway, catalysts are in place, market still doesn't really care, maybe because they think it's going to take a number of years and they prefer to focus on something else in the short term. And we will buy anyway for that recovery in the share price, because it's in our target market cap space. Good example of that would be Argentex, where that management change was underway earlier this year, and where the business missed its IPO numbers, and one of the co-founders left and then sold all his stock in the market, spooking everybody. Argentex does FX services to small and mid-sized companies. It has over 1,000 customers, and it basically undercuts the big banks who typically overcharge for their FX services and don't have very good levels of service. So Argentex delivers both of those things, cheaper and much better levels of service, and as a result, it's been growing really very strongly in the last few years. There's a much better known business that does pretty much exactly the same thing on the market called Alpha FX, which the small cap funds all own or love. Quite a lot of them do love, which is 840 million market cap. Little old Argentex currently valued at 157 million market cap. And interestingly, Alpha FX's sales are about 100 million. Argentex is about half, about 50 million, and Argentex makes about 14 million of profit. As you can see, Alpha FX makes just over double the profit. It's got more scale, so its margins are a bit higher than Argentex until Argentex catches up. So you can see the valuation placed on Alpha FX is much greater than Argentex, and we were able to buy that earlier this year at about 70p, and it's performing very strongly. So up to about 130 or so now. That's the long-term returns in small cap. For those that are worrying about what does 2023 hold, I'd encourage them to think more about what does owning small cap over the long term hold. And it means if you hold small cap over the long term, you should generate a much higher return than all those other categories there, i.e. larger companies, mid-sized companies, and a range of other asset classes. That chart goes back to 1955. Obviously, it's a long-term average, but the small cap effect, we believe, is well and truly in place. If we touch on our views on next year, the revulsion, as I call it, of the UK is pretty clear to me. Everyone hates us. They hate our stock market. They almost revel in the fact that France has got slightly bigger than us a month or so ago in terms of their stock market. We are worried about markets that overall going into 2023. We think the key driver is obviously inflation, and whether core inflation can be brought under control. That will require wage settlements to be sensible for that to deliver. But if we look at a range of measures such as oil price, freight prices, interestingly, the wheat price is now back below pre-Ukrainian freight invasion. A number of the factors that have been affecting measures in inflation have clearly come over. So that's what determines it, and determines the path of interest rates, will determine how difficult markets will be. There is huge amounts of dry powder on the side, both from companies. Interestingly, Crestchic has bid from Aggreko, but Aggreko is now owned by private equity. So there's a real live example of dry powder being used up to augment other businesses whilst the UK sleeps. Recessions, the last sort of 6 recessions have lasted between 6 and 18 months, and the market always bottoms before the end of the recession. That's happened on every occasion. So we would expect, was obviously in the recession, we expect the recession to last probably most of next year, If it lasted all of next year, we might see some sort of bottom in market sometime during next year, but probably not in the short term. And liquidity remains a real issue for everybody. We really thankful at Rockwood Strategic that it's a long-term capital fund, that we don't suffer from redemptions, but we know friends and relationships we have in small cap world that the redemptions in UK small cap open-ended funds is not being helpful for people supporting their companies, or indeed buying the cheapest ones when people are asking for their money back. I would reiterate finally on this that I can't stress enough that the pathway for Rockwood Strategic, like it has been this year, will be driven by our stock-specific outcomes, which are likely to be pretty uncorrelated with the UK market over the short term. This is the performance. It's actually a bit out of date because we're waiting to the end of December to update the main chart. So just at the bottom, you can see NAV's up 6% year to date, share price total return up 20%. We were on a bigger discount, and we've been driving that in to nearly par. We're very close now in what's clearly been a very tricky market for the indices, as you can see at the bottom of that page. Our investment advisory group, if anyone's asked about that, I can come back to that, but they are a source of great insight, help, network, and introductions to help Rockwood. But and I think someone has asked about fees. So we have materially reduced the fees at Harwood in Rockwood Strategic for its operating costs, and we're looking for the OCF on a normalized basis to be about 1.6, 1.5, 1.6. It sort of depends exactly on the scale. For now, in order to help shareholders, we are actually only charging a flat fee of £120,000, which we've committed to until we get the NAV to 60 million. We're currently at about 42 million. So it is very, very cheap relative to the fees that are charged for these types of approaches. But we will, once we get to 60 million, increase the fee to a more normal 1%. We also have a performance fee to completely align us with the outcomes here. And what we charge is 10% on everything over the 6% hurdle, which compounds up weekly and has a high watermark. And I can answer more questions if that's unclear, or do email us and we'll explain that further if that's unclear to anybody. We moved to the main market as an investment trust in September, which means that we won't be paying any further capital gains tax. There was a charge for that as a result of the structure before. And we're hoping that widens the audience for us. You can see there with the top shareholders, we've got 28.9. I'm at the bottom there with one number of very supportive and very experienced wealth manager, fund managers that have invested in the strategy. So that's about it, Alex. I think we should probably go to Q&A if you give me
Richard, yes, thank you very much indeed for your presentation. So what I'll do now is bring up your camera. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Richard, as you can see, we have received a number of questions throughout today's presentation, and thank you to all investors for submitting their questions. Richard, could I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end. Thank you.
Great. Thank you very much, Alex. I'm a bit of a novice at doing this, reading these. So I'm sort of reading them and then responding to them. I'll do as many as I can. So someone has asked, what will be your dividend policy going forward? Well, with the move to the main list, we've adopted the policy of distributing 85% of all income received into the portfolio net of expenses. I'd love to give you a more accurate number of what that is right now. I don't actually have that, but it's likely to be very small because the expenses relative to the income, it's quite a lot of it. So we're not anticipating to, at this stage, providing a significant yield off the portfolio. And what's behind that is really our view that we want to do everything we can to increase the scale of the fund and distributing out. So just that that policy will be under review when we get bigger. So it's not a long-term policy. Someone has kindly said, great progress. What do you plan to do with the cash coming into the portfolio from the recent takeover? Will you be adding to existing positions or adding new holdings? Any new sectors of interest? Good question. Well, first of all, it's great to be having a load of cash coming into the portfolio. We haven't been short of ideas this year, and actually our cash positions got as tight as we would want it in this strategy. So we're kind of run rate now. Then when we next report, it's probably down to about 2.5%, 3%, which is about as low as we really want it to be. So fortunately, it's great. It's also a great environment. So some of our holdings we will add further to with some of that cash. I'm obviously not going to tell you that in advance who those are, but there are 2 or 3 candidates for additional investment once that cash comes in. But most of the cash will go into new positions. And I would think about it like this. Firstly, we're not in a rush because it's one of the worst things in investment. Secondly, though, the environment in UK small cap is pretty fruitful at the moment. So there's lots of things that are clearly mispriced. There's people looking to generate liquidity from their holdings being sort of forced to do that. And equally with a recession and generally the maturing of some businesses with terms of their strategies, there's also a desire for new capital as well. We expect in the first 6 months of next year. So we expect to make a number of new investments. We've got a really full pipeline. I'd love to say it's sector kind of the obvious sector, but actually the pipeline has quite a disparate range of sectors, which is just the way UK small cap is. I thought I'd end up having more consumer-based businesses because of how the backdrop's been to that sector, consumer squeeze, rate squeeze, post-COVID, all the rest of it. And actually there are a couple of consumer things we're looking at, but it's not as many as I thought. We haven't seen quite the opportunities we think are low risk enough in that sector. We would seek to at least we're looking to make 1 to 2 what we call core investments, which would be 5 to 10% type weighted positions, at least 7, 10, maybe even more than 10% during next year. And we would also, and then a number of other springboards to then go to core. The most dangerous thing with this kind of structure, though, is to try and think we can find 3 absolutely brilliant or 4 absolutely brilliant, high stake, high engaged recovery situations where we really think the risks are misunderstood by the market and do that really quickly. So we are in no rush to deploy that cash until we find things we really love. RM would be a good example of one we found this year and is already up materially from when we bought it, and we still got loads and loads of upside. Hopefully that's helpful. How are you finding liquidity in the companies you are invested, and what impact is this having on valuations? So the liquidity is basically poor, which is why in some of the springboards or opportunity type positions, the liquidity is a bit better. Often those have slightly higher market cap, but liquidity is poor, which is why we're focused on our medium-term plans for value realization. And also we're looking to where companies have excess cash, have that returned to us. One of our companies, Smooth, has announced a tender offer to return about £5 million and 25% of the market cap back to shareholders. That will come in as well. But liquidity is poor, but we feel Rockwood is one of the best places to exploit that and handle that than, say, a normal open-ended small cap fund. And it is having a big impact on valuations. There's just absolutely no doubt about it. You can just see it across all sectors. The illiquidity is becoming a real problem. And compliance departments in larger firms, we hear, are forcing small cap managers to sell particular stocks, even when they like them, because they don't like the liquidity profiles. Someone's asked, how will you go about raising further capital to achieve scale? So our hope and plan is that we, in the very near term, make that last little bit and get Rockwood trading at around par or just over par, and then we would seek to we would love to then seek to grow it via modest amounts of issuance to those that wanted to support the strategy and grow the strategy. So that would be we have in place a placing program with Singer Capital Markets, which allows us to raise a significant amount of money, i.e., actually £40 million in the next 12 months, if very significant wealth management groups or other actors wanted to put significant amounts of money in. But I suspect it'll be a mix of small, and we'd love to just get going with modest amounts of issuance in the first instance. Yeah, hang on. Here we go. Simon sees us. On Pressure Technologies, you recently added substantially to your investment following a big drop in the share price in September. What gave you the confidence to do that, and what's the likely exit? Great question. So Pressure Technologies has been probably our most disappointing holding this year. The business has, in fact, I might. There we go. Here we go. There's a slide there. If you can see, hopefully people can see that on Pressure Technologies. So the business there, it's been in the portfolio since early 2019. In industrial business, just a quick preamble before I answer your question, Simon. It has two divisions. One is a really interesting business that's been around for a long time called Chesterfield Special Cylinders. You can see some of their cylinders there on the top in those two top right pictures. They make these very high quality and high spec tested cylinders for a range of clients, most notably the Ministry of Defence, where their cylinders are going into the new nuclear submarines, but also are sold to the French Navy, the Air Force for ejection seats, all sorts of others where high pressure cylinders are required. That business has a very lumpy order profile, which, to be frank, it's really difficult to handle as a small company, and would be much easier to handle within a much larger manufacturing business in the defense industry. But it is a profitable business, and they have good contracts in there. That business is becoming super exciting, and we expect that to catch the headlines during 2023, which, Simon, is one of the reasons we are excited about financing it, is that its cylinders are now being purchased for the emergent hydrogen economy, primarily for refueling stations, but some other aspects of that economy as well. And they're in lots of very interesting discussions with which they talk about publicly with a range of serious players in the emergent hydrogen economy. That sales are up to maybe 13-14% of the sales of Chesterfield now, but we think could easily go up 50% again in 2023 potentially double during 2023 if some of the discussions come through, which would mean that the hydrogen part of the business could be 20% of sales, but growing at some lick with quite a lot of potential. At the same time, the business is still awaiting the orders for the final 2 nuclear submarines, which are very material contracts, and we would be hugely disappointed if they weren't to win those. The second part of the business is called Precision Machine Components, and that's been a really difficult business they've been trying to sort out. It was by a prior management team, a collection of businesses they acquired and tried to sort of stitch together. And that's been restructured heavily in the last couple of years, but it's highly dependent on the oil and gas market, which has also been weak. There are major parallels here, which is why I started to get more excited about this, but actually in the major parallels here with the strategy that we adopted with Northbridge and Crestchic, in that we feel that PMC should not be within the group, and the company have now adopted that with this fundraise as the strategy to and have appointed advisors to seek an outcome for that division. We think that will then focus the company and the stock market on Chesterfield. They should get some money in for PMC. I've put quite a wide range there because that's probably the most prudent thing to do at this point. But we expect the PMC business to grow its sales further in 23 from 22, given where we are in the oil cycle. They also have a very large facility, Simon, which up in just off the M1 in Sheffield, that's freehold, 120,000 square foot. There's a picture of it there on the bottom right. And we feel that that is a significant asset for the business, which could be utilized to improve its overall financial stability. The part of the crash in the shares was because the lumpy contracts didn't drop in time, and part of it in terms of the reporting cycle, and also they needed a new refinancing package, which fell away at the last minute, needing shareholders to be supportive, which is what we've done. So we had 13.5% of it, and we've gone up to 19.5% of the business, and we got a CFO change to occur, and we're really rolling up our sleeves here and hoping that a proper turnaround from this point is now on the cards. Hopefully that helps you. What would be your maximum position size given the illiquidity of these businesses? So in terms of position within the weighting, within the weightings, so it's a difficult question. It's slightly out of our control to an extent. We would, historically, say with Augean, we started trimming some Augean when it got to about 25% of the portfolio, even though we were still very confident in that there would be an outcome at Augean and that it was in good shape. So we started being nervous overall, not nervous, but the board, other investors, and the concentration within the portfolio. But normally that 25% is a result of a thesis coming through. So we'd never take 25% in the first instance. We're more likely to take 10, the big positions would be 7, 8, 9, 10, 11, 12% type positions. And then when they do really well, they end up at 25, which is actually a much lower point to have 25% in the portfolio. With Crestchic, we didn't sell any at all and have maximized the return for shareholders. But I think, Jamie, the way to think about it is, it's almost like we're not that fussed about liquidity from a stock market perspective. We're not having redemptions coming into Rockwood, and we work out this exit thesis, which requires liquidity via probably a trade sale or a private equity approach or as we have done in the past, it's just so good that lots of other small cap managers actually want to own it now, and we sell out to those. Slightly long-winded. I apologize for that answer. Just checking I haven't missed any that I think would be. I think that's. Oh no, hang on. Sorry. There's a sort of list of them here. Oh, someone's asked, why do you own Galliford Try? So I'll finish on Galliford Try. I promised I tried to keep it short, and I haven't really done that. Apologies, everybody. Galliford Try, very, very interesting situation. Market cap's about 175 million. It's a construction business. The market and fund managers typically hate construction market these days. They used to actually quite like it, but as a result of Carillion, Molam, Costain, God knows what, essentially, it's a really hated sector, and hate means low valuations. Galliford Try and indeed Balfour Beatty, which is far too big for Rockwood, but if anyone looks at it, we'll see it's actually been performing very strongly this year, and I think that's relevant to Galliford Try. Are some of the survivors. They've learned the lessons of the sector and have massively reduced their risk appetite on what contracts they take on. And both businesses, both Balfours and Galliford's, have been improving their profitability as a result in the last 2 to 3 years. The new management team at Galliford's have taken margins up to about just over 2% now, and they're targeting 3%. It sounds like a very low margin, and it is, but sales at Galliford Try are over £1.3 billion. So moving from 2 to 3 is a 50% increase on in terms of actual profits. So there's still a material profit improvement recovery to occur at Galliford Try. Now, believe it or not, Galliford have a spot cash of over 200 million, and they talk about an average cash position of 175 million pounds. Some of which are customer advances, but it doesn't really drop below that level. So they've got for any period of time, material period of time. So they've got basically their entire market cap in cash. They also have nearly 50 million quid's worth of old PFI investments, which are infrastructure style, long-term annuity style investment streams, which have value and which trade and is additional value. And the business has over a £3 billion order book. Now, if we're looking into 2023, I can tell you companies with a £3 billion order book and over 90% of sales booked already for next year, or they know they're going to get it, is a nice place to be. It might provide really, best in class earnings momentum during 2023 versus other sectors that are under stress. The company have recently started by buying back their shares. And despite that, they actually have a 2 times dividend cover on a yield. The current yield's over about 5.5%. So we see a proper re-rating as the market focuses on that. Hopefully, that's answered that question. So
that's great. That's great, Richard. Thank you. And I think you have addressed those questions you come from investors. And of course, the company will review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. Before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Richard, could I please ask you for a few closing comments? Thank you.
Yes, well, thanks very much, Alex. Thanks for everybody that's listened in. We wish you a very Merry Christmas. We hope if you don't own Rockwood, you'll consider us for your New Year portfolios. If you already own Rockwood, we hope you're very pleased with us, and we are super energized to keep delivering for all of you. Remember, we are focused on 15% IRRs. We don't care about benchmarks, we don't care about sector compositions, and we're completely 100% focused and aligned with all of you to keep delivering at Rockwood. And as I say, Merry Christmas to you all, and thanks for the time you've given to listen today.
Richard, thank you once. Thank you once again for your time and for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I am sure will be greatly valued by the company. On behalf of the management team of Rockwood Strategic PLC, we would like to thank you for attending today's presentation. Good morning to you all.